There are a few factors, but the main one is related to currency differentials. And so because the entire world needs dollars, there's a lot of persistent demand for dollars. And so if you look at most countries, if they start to run persistent trade deficits for a while, then the next time they have a recession or some sort of financial event, usually what happens is their currency ends up getting pretty weakened. Right? There's kind of a, the international market realizes there's a problem there, and you end up having, so much outflows that you have a currency weakening event. And what that does is, it's painful when it happens, but when it happens, it makes their export competitiveness stronger and it reduces their import capability. And so it ends up realigning their trade deficit back towards a more balanced state. But the United States, we never go through that process. When we have recessions, often our dollar gets stronger. And so we never are in a position where our currency kind of makes sense relative to our balance of trade. We don't have that corrective mechanism that most other countries have. And that's kind of that's the core issue. Then there's some other factors like, just fiscal policy and kind of geopolitical policy. And so a lot of these other countries have rather mercantilist policies where they try to purposely maximize exports, and keep their import power, somewhat tight. So a lot of them will purposely weaken their currencies as much as possible compared to the U.S. dollar. And for example, Switzerland will just print a lot of their currency and then buy, American assets, for example. And
Apple.
exactly, even Apple stock. Yeah, so it started, of course, with treasuries, right? You print money, you buy treasuries, you build up your foreign exchange reserves. But they've also moved into even just outright buying U.S. equities. And so what that does, and that, Switzerland's like they probably do that more egregiously than any other country, but there are a bunch of countries that do that. And whereas the U.S., we purposely never really built foreign exchange reserves. We don't go through these processes of purposely weakening our currency unless there are a handful of times we got really bad, like in the Plaza Accord, 1985. But so we generally don't engage in that kind of currency weakening. We also have other things like, for example, the United States has the most expensive healthcare per capita in the world, and that of course is often that burden is often supported by employers, right? So, it's much more expensive to hire someone when healthcare is twice as expensive if you're obligated to basically pay for that employee's healthcare compared to if you were operating in another country. And
Right.
so there are a variety of factors related to tariffs, related to monetary policy, all sorts of reasons. Uh, and it revolves around the fact that the United States has to get dollars out into the system if those dollars are going to be able to be purchasable for commodities for countries around the world.
Yeah, and an environment domestically that allows us or incentivizes us to get that manufacturing overseas. So it's not just about prices, about what you're saying, but I also want to focus or just mention that it's a lot to do with regulations as well. I mean, you touched on it there with the healthcare, but if the government imposes heavier and stricter regulations, it doesn't make a lot of sense for someone to take that $1 billion out of their back pocket and take 10 years to build a manufacturing plant in, let's say, California, when you have no idea what the political environment is going to be. You have no idea what the taxes are going to be, the regulatory environment. It's not a good risk reward. So I think that's one thing that people overlook, and from a macro standpoint, we don't really focus on. But as a former entrepreneur, I know that that's extremely, extremely important. Local and domestic regulations.
Yeah, and so the net result over time was we had a financialization of our economy. And so
Right.
we stopped making real things. We started financializing things. So we're providing financial services, becoming the financial hub of the world more and more. We also have, of course, had a very big healthcare industry, big military industrial complex. And then, one of the benefits of it, we did have a pretty strong technical sector, which most people know. A lot of that was centered around software, right? Because that doesn't really rely on making things, as well as engineering designs that we would then, have people make that in other countries. And so basically anything that's really high margin, we're able to do. But anything that involves physically making things is where we're increasingly weak at. And so this lasted for several decades. It's there's trade-offs there. And so we've seen some areas, for example, like the Rust Belt, that the Midwest,
Right.
that's really suffered because that's where a lot of our manufacturing base was. Whereas you've seen, for example, the coasts flourish because that's where a lot of the financialization is, or the software, or the healthcare. And so we basically hollowed out the center of our country, hollowed out kind of the blue collar sort of work, and really doubled down on the coasts, on the white collar work, and things like that.
So what does that do to wages over the
Well,
long?
yeah, definitely, it deeply suppresses wages, because in addition to hiring fewer, domestic manufacturing workers, the ones that remain have a lot more foreign competition. Because they're always at risk of having their plant outsourced to Mexico or China, wherever the case may be, and so that puts a lot of downward pressure on wages, especially for, again, people that work in skilled manufacturing, or routine tasks, and or even rather technical, because, for example, if you look at some of the high-end manufacturing areas like Japan or Germany, right, a lot of that is advanced technicians. And the United States is even outsourcing a lot of those types of people just because we're not making the physical goods here nearly to the extent that we used to, or compared to many of our kind of advanced industrial peers.
Yeah, and it seems to me what has happened is we've turned into an economy that really revolves around financialization, to your point, but also just domestic services. Like
Exactly.
you go around the block and look at what all the businesses are. And I did a video the other day. We talked about Uber, we talked about DoorDash or Topgolf or restaurants, bars, cafes, accountants, lawyers. It's like 90% of the businesses you see revolve around just selling domestic services to one another. And if you really think about it, you're like, okay, well, where's all the stuff coming from? It's
Yep.
like
Mostly
it's
mostly
not coming
China.
from here.
Yeah.
Yeah. And then one more thing I'd like you to touch on. It's fascinating. I was actually listening to a Jordan Peterson video the other day, believe it or not, one of his classroom lectures. And he started talking a little bit about macro. And you can tell that he's read some books on it. I know he's not an expert, but you can definitely tell he's read some books. And he started talking about the demographic shift, or more women coming into the workforce during this exact same period in the 1970s, and how you basically doubled the competition for jobs, and that might have had an impact on suppressing real wages as well. Do you think that was a factor, or do you think it was really more about the petrodollar system and outsourcing these jobs to foreign countries?
I think it's one of those things where there's always multiple variables. One thing is, if you look at most other developed countries, they had a similar demographic shift, right?
Yeah.
Because we had more women coming into the workforce. But for example, those countries almost exclusively have less wealth concentration than the United States.
Mm.
So their overall middle class generally has a better standard of living in some ways compared to U.S. middle class, even though our, say, top 10% are far, far wealthier than their top 10% on average. And so a lot of this was based on specific policies that the United States did,
Right.
although of course there's always multiple factors involved, and there is more competition for jobs now, both internationally, and it's actually, if you look at, it's interesting, if you look at Japan, Japan has been slower than most other countries to bring women into the workforce. But that's actually, they've increasingly turned towards that because of, most people know they have a shrinking population now. So they have some of the most aged and slowest growing demographics in the world. And one way that they, handled that over the past decade or so is that they've seen a sharp rise in women in the workforce. And
Right.
it's actually kind of crazy because even though their country's 10 years older on average, like their median age is 10 years older than the United States, in 2020, they actually have a higher labor participation rate than the United States, because we
Overall,
had
women.
overall age
Wow.
15 and over. Yeah.
Hmm. Now, is that because Japan, I don't want to go off on too much of a tangent here, but is that because Japan is really propping up a lot of these zombie companies? Because I talked to Snyder about that, and he's like, Japan is already doing MMT, and they basically already have a jobs guarantee program.
Yeah. Well, I think part of it also is that they don't have that trade imbalance, right? So their trade balance is pretty much settled, and so they have a healthier blend of making things as well as some of the more financial services. And as far as MMT goes, for example, they have been running smaller, sovereign deficits as a percentage of GDP than the United States has. And so we all know of Japan as like their central bank balance sheet going vertical, but the actual growth of the money supply and the sovereign deficits as a percentage of GDP have been lower than the United States. So they actually have far slower M2 growth over the past 10 and 20 years. And so I would somewhat not quite call that MMT in the same way. It's of course there's a lot of similarity. There's a lot of financialization. It's a little bit different than the idea, for example, running a $3 trillion stimulus and just injecting that into the economy. They haven't really been doing that to quite to the same degree that we have.